Imagine for a second that you've spent, the last 20 or 30 years just building an empire.
Oh, yeah. Blood, sweat, and tears.
Exactly. You've poured everything into growing this successful business from the ground up. You've got a solid property portfolio, and you've generated real generational wealth.
Right.
But if you are, like most founders out there, there's this lingering, quiet anxiety in the back of your mind.
Always.
You want to make absolutely sure that one bad lawsuit or like an economic downturn or some sudden tragedy doesn't just wipe it all out overnight.
And to prevent that, the wealthiest families don't just buy insurance,
Yeah.
They build a fortress.
They build a fortress. But here's the secret that, well, most business owners really don't realize. If you don't structure the transition of that fortress correctly, it becomes the very thing that traps and bankrupts your family.
It really does. It's terrifying.
So today we're doing a deep dive into the ultimate South African asset protection tool, the family trust.
Yep.
We are pulling from this definitive guide, The Founder's Legacy, and we're also looking really closely at the methodologies of trust consultant Lumka Sturman.
Her work is fascinating.
It is. We want to figure out how to build this fortress properly and what actually happens when the original architect suddenly leaves the picture.
The contrast between a properly functioning trust and a neglected one is, well, it's staggering.
I bet.
We are talking about an incredibly robust legal structure here. It can shield your life's work,
Yeah.
but it is entirely dependent on the fragile human element that actually runs it.
Right. Because the ultimate goal of setting up a trust in South Africa is to ensure the wealth outlives the founder.
Exactly. And to understand how things fall apart, we first have to understand the immense positive power of why you'd even build one in the first place.
Which brings us right to a foundational concept from Lumka Sturman's practice. Her entire methodology hinges on one defining principle: separating ownership from risk.
Yes, and I'd argue it is the single most important move a business owner can make.
How so?
Well, think about how most entrepreneurs start. Your trading company carries the inherent risk of doing business in South Africa. You've got employees, suppliers, creditors.
Sure, all the day-to-day stuff.
Right. And you might be signing personal sureties to get loans or lease agreements. If your valuable assets, like your family home or your investment properties, are owned in your personal name, you're walking a tightrope.
Or even worse, if they're held within that trading company itself.
Oh, absolutely. One massive lawsuit, one bad supplier, or, a severe SARS audit, and that can threaten everything you own.
So it's essentially like, I like to think of it like building watertight compartments on a ship.
I like that analogy.
Yeah, if your business hits a reef and takes on water from, say, a liquidation or a lawsuit, the doors just seal.
Right.
The risk stays contained in the business compartment, and the trust compartment where your family's personal wealth is sitting, that stays perfectly dry.
That is a brilliant way to visualize it.
Oh.
By legally transferring your assets into a trust, you are creating that watertight seal.
Because you don't legally own them anymore.
Exactly. You've severed the tie between the business risk and the family wealth. You minimize that mixed personal and business liability that honestly traps and ruins so many small business owners.
And beyond just the liability side, a properly structured trust is actually a highly efficient tax vehicle.
It really is, though people often misunderstand that part.
Right, because I noticed in the sources they mention a flat tax rate of 45% for trusts and an effective capital gains tax of 36%.
Yeah.
On the surface, to a layperson, those numbers actually sound incredibly high.
Oh, they do sound high. But the magic of a trust lies in its flexibility, specifically something called the conduit principle.
Okay, break that down for us.
So if the trust retains the income, yes, it pays those high flat rates. But the trustees have the power to distribute that income, or the capital gain, to the beneficiaries before the tax year ends.
Oh, I see.
When they do that, the income flows through the trust and is taxed at the individual beneficiary's personal tax rate.
Wow, okay. So if you have beneficiaries in lower tax brackets, the overall tax burden for the family just plummets.
Exactly. Plus, because the assets are growing inside the trust and not in your personal name, a properly structured trust significantly reduces the estate duty your family will owe when you pass away.
So the fortress really is practically impenetrable from the outside. SARS, creditors, lawsuits, they all hit that structural wall.
They do.
But let's look at the vulnerability here. What happens from the inside when the architect, the founder who built that watertight ship, suddenly passes away?
This is the tragedy highlighted time and again in the founder's legacy. Trusts rarely fail because of a poorly drafted legal clause.
Right.
They unraveled because, in practice, the founder operated as if they were the trusts.
Ah.
They made every investment decision. They held every relationship with the bankers. They knew the history of every property.
So when they die, the trust just enters this period of complete administrative paralysis.
Complete paralysis.
But hang on, I'm a little confused by that. A trust is a massive, legally binding contract, right?
Yes, it is.
So if I die, I still have surviving trustees listed on the paperwork, usually like a spouse or an independent accountant.
Sure.
Why wouldn't the legal paperwork just step in, empower them, and run things on autopilot?
Because there is a massive gulf between having the legal authority to do something and having the practical capability to actually execute it.
Oh, right.
The surviving trustees might have the legal right to manage the trust, but they are immediately hit by what we call the information gap.
The information gap.
Yeah. The founder held all the unwritten handshake deals, the rationale behind why certain stocks were bought, the direct contact numbers for the plumbers and electricians who service the trust's properties.
All of that data was just living in the founder's head.
Exactly. It dies with them.
The Naidu family case study in the sources is a perfect example of this.
Oh, that one is wild.
It really is. The surviving family only found out that their trust even owned a specific commercial property because the tenant literally called them up, confused, asking where to send the rent money for the month.
Can you imagine the sheer panic of that moment for a grieving family?
It was awful.
The founder handled the property management personally, keeping all the documents at his office. No records existed at the family home.
So the family was completely in the dark.
The Naidu family had to spend weeks reconstructing the trust's entire asset register just by combing through old bank statements to see where money was coming from and going to.
That sounds like a nightmare.
And that information gap triggers an even worse administrative nightmare, known as the notification cascade.
Which is when all the institutions suddenly freeze you out.
Every single one of them, banks, investment managers, insurance companies, they will not let surviving trustees just carry on.
Because they need proof.
Right. They require official death certificates and, more importantly, updated letters of authority from the Master of the High Court to legally confirm who the current surviving trustees actually are.
And anyone who has dealt with the master's office knows getting those updated letters isn't a matter of days. It can take weeks or frequently several months.
During which time, the banks completely freeze the trust's accounts.
Just totally locked.
The Govender family case study illustrates how destructive this is. When Mr. Govender died, his widow didn't even know which banks held the trust's accounts.
Wow.
It took her 3 months just to locate the various institutions. And while she was searching, and while the accounts were frozen waiting for the master's office, a massive fixed deposit matured.
Oh, no.
The bank automatically dropped that money into a standard zero-interest call account. It just sat there, dead in the water.
Because she couldn't legally instruct the bank to reinvest it into a high-yield account.
Exactly. The Governor Trust lost 40,000 Rand in interest in just 3 months.
That is brutal.
Not because the market crashed, but simply because of administrative paralysis.
Okay, so the missing paperwork and these frozen bank accounts create this immediate, incredibly stressful bottleneck for a grieving family.
Yeah.
But reading through these sources, there is a much deeper structural financial issue lurking in almost every South African family trust.
Oh, absolutely.
An issue that can literally force a family into bankruptcy if they ignore it. And that is the loan account.
The loan account is arguably the most misunderstood element of trust structuring in South Africa.
For sure.
To grasp why it's a ticking time bomb, we have to look at how these trusts are actually funded in the first place. You can't just take a 10 million Rand property and just give it to your trust.
Wait, why not? If it's my trust and my property, why can't I just transfer the title deed over?
Because SARS will hit you with donations tax.
Yeah.
In South Africa, if you give an asset away, you are taxed at 20% of its value.
Okay, so giving a 10 million Rand property to your trust means a 2 million Rand tax bill payable immediately.
Exactly. To avoid that massive penalty, founders use a perfectly legal loophole. They sell the asset to the trust at market value. But the trust is a brand new entity, right? It has no cash to buy the property.
So the trust essentially writes a massive IOU to the founder. I owe you 10 million Rand for this building.
And that IOU sits on the trust's balance sheet as a loan owed to the founder. Now, fast forward 20 years. The founder passes away.
Right.
That loan, that massive IOU, is legally considered an asset belonging to the deceased founder's personal estate. And deceased estates are subject to estate duty.
Which is pretty steep.
Every South African gets a baseline exemption called an abatement before estate duty kicks in. Currently, that's 3.5 million rand. But anything over that abatement gets taxed at 20%, jumping to 25% for amounts over 30 million rand.
Let's use the Chetty family case study to make this terrifyingly real.
Good idea.
So the Chetty family trust owed Mr. Chetty 20 million rand on a loan account at the time of his death. So suddenly, his deceased estate is looking at this 20 million rand asset.
Right.
And after the abatement, SARS is demanding roughly 3.5 million rand in estate duty. But Mr. Chetty's personal bank account didn't have 3.5 million in cash just sitting around.
And the executor of Mr. Chetty's estate has a legal obligation to pay SARS. So the executor turns to the trust and says, hey, you owe the deceased estate 20 million rand. Pay up a portion of that right now so we can settle the tax bill.
But the Chetty Trust didn't have cash either. All its wealth was tied up in illiquid commercial properties.
Exactly.
It's like a financial boomerang. You threw the assets out into the trust decades ago to keep them safe from business risks, but upon death, the massive tax liability of that initial throw comes flying right back and hits your surviving spouse square in the head.
That is exactly what happens.
Yeah.
The Chetty Trust was forced to hurriedly liquidate a property in a buyer's market just to generate the cash for the estate duty.
Ouch.
They had to sell it at a massive discount, which ended up costing the family 800,000 rand in lost value.
Just throwing money away.
All because they hadn't planned for how to settle the loan account at death.
Uh-huh.
And the financial pressure gets exponentially worse when you factor in Section 7C of the Income Tax Act.
Oh, right. This is the Van Zyl family case. Section 7C is a relatively recent addition to the tax laws, right?
It was introduced to stop founders from using these interest-free loans to dodge taxes indefinitely. Section 7C essentially dictates that if you loan money to a trust, you must charge interest at the official SARS rate.
And if you don't?
If you don't charge interest, SARS deems the missing interest as an ongoing annual donation and taxes you on it anyway.
So to comply, founders charge the interest.
Right. But again, the trust has no cash to pay the interest monthly.
Wait, so the sources mention capitalized interest. Just so we are crystal clear, that means instead of the trust paying the founder cash for the interest it owes, it just adds that interest to the total debt.
Yes.
Meaning the debt is snowballing and getting bigger every single year.
It creates a massive compounding snowball. When Mr. Van Zyl died, his trust owed him the original 8 million rand loan plus 1.2 million rand in capitalized compounded interest.
Wow.
His widow inherited his entire estate, which meant she inherited that massive loan asset.
She stepped into his shoes, and she assumed the complex interest issue just died with her husband.
She had absolutely no idea that legally, because she was a connected person to the trust, Section 7C continued to apply to her.
Oh, no.
Yeah, she was legally required to keep charging the trust interest going forward. She inadvertently inherited a highly complex, snowballing tax obligation that she was completely unprepared to manage.
Putting her at severe risk of SARS penalties.
Exactly.
It's wild how quickly the tax bill and the administrative burden snowballs. But as devastating as that financial hit is, money can eventually be recouped. Properties can be repurchased. What you cannot easily fix is what happens to the people left inside the fortress when the money dries up and the communication breaks down.
That's the real tragedy.
A poorly managed trust transition often breaks family relationships permanently.
The human element is the ultimate stress test of any wealth structure. During their lifetime, the founder acts as an informal buffer.
And the peacekeeper.
They know the personalities, they balance the competing interests of the children, they keep the peace. When the peacekeeper dies, you are left with a sudden, volatile, dynamic shift.
Like with the surviving spouse.
Right. They usually experience a jarring transition from being a passive signee who just trusted their partner to handle the money to suddenly needing to be an active, legally responsible trustee.
If a founder is listening to this right now and thinking, you know what, my family is different, we get along great, we have Sunday dinners, they would never fight over this kind of thing, what is the reality check they need to hear about the psychological stress of grief combined with sudden financial ambiguity?
The reality check is that grief fundamentally changes people's behavior, and ambiguity always breeds suspicion.
Always.
When the rules aren't clearly written down, everyone assumes their interpretation is what the founder would have wanted. Look at the Nike-Icker family.
Yo, that was a tough read.
Mrs. Naker, the widow, simply assumed the trust money was theirs and freely available to her to maintain her lifestyle. She didn't understand the legal barrier between her personal bank account and the trust's capital.
She suddenly found herself in a position where she had to ask her own adult children, who were her co-trustees, for basic living expenses.
And the adult children had a completely different view. They believed the trust capital needed to be preserved for the next generation. They started scrutinizing her spending.
Just horrible.
It was deeply humiliating for a mother to have to justify her grocery bills to her children, and it destroyed their relationship.
It sets up this brutal spouse versus children dynamic. The sources highlight the Pillay family as well, which is heartbreaking because both sides had valid desires.
Exactly. No one was really being malicious.
Right. The widow wanted to continue living in the very valuable family home that the trust owned. It was her sanctuary. But the adult children, who were co-beneficiaries, wanted the trustees to sell the house and distribute the cash because they felt they had been waiting years for their inheritance to start their own businesses.
And without the founder there to mediate, and without a clear written directive explaining whose needs should be prioritized, there was no mechanism to resolve that conflict. The family fractured into legal factions.
Which just drains the trust with legal fees.
Oh, absolutely. You also see incredible power vacuums open up when the dominant personality leaves. In the Pretorius family, you had a mother and her eldest son acting as co-trustees.
Okay.
While the father was alive, the son naturally deferred to him. When the father died, the son simply assumed he would step into his father's shoes as the dominant decision-maker.
But the mother saw absolutely no reason to defer to her son. She had been a trustee just as long as he had.
Right. So decision-making became entirely paralyzed. Every single discussion about whether to repair a roof, sell stock, or make a distribution became a toxic proxy battle for family dominance.
And the assets just suffered.
The trust's assets stagnated because the trustees couldn't agree on anything.
So we've seen the incredible protective power of a trust, keeping the business risk far away from the family wealth. And we've stared into the absolute abyss of an unprepared transition, where frozen accounts, tax boomerangs, and power struggles tear a family apart.
It's a lot to take in.
It is. So how do you, as a listener, ensure you get all of the benefits of the fortress without leaving a nightmare for your family?
It really comes down to shifting from reactive administration to deliberate preparation and professional partnership.
Proactive, basically.
Exactly. The sources contrast two final case studies that perfectly illustrate this: the Mola family and the Botha family.
The Moleff family is the absolute gold standard here. Mr. Moleff knew he was ill, and instead of hiding from it, he leaned into the preparation.
He really did. He created a comprehensive physical trust manual. He documented every asset, the rationale for every liability, and all those unwritten handshake arrangements with suppliers.
That's amazing.
But crucially, he didn't just leave a book on a shelf. He held monthly family meetings with his wife and adult children to review the trust's administration together.
So they actually knew how it worked.
Right. He physically brought them into the room and introduced them to his attorney, his accountant, and his financial advisor.
So when he passed away, the family was certainly grieving, but they weren't scrambling in the dark. They knew exactly where the accounts were, they had relationships with the advisors, and the transition of power was seamless.
The fortress held.
The fortress held. Now, compare that to the Botha family.
Total opposite.
Mr. Botha was fiercely secretive. He believed that holding the financial information close to his chest was a way of maintaining control. He administered everything personally for 2 decades.
And when he died suddenly, his family knew absolutely nothing. The trust deed itself was locked in a safe deposit box at a bank they didn't even know he used.
They were only identifying trust properties when municipal rates bills happened to arrive in the physical mail.
It's unbelievable.
And a commercial tenant, realizing the founder had died and the family was in chaos, simply stopped paying rent because nobody was enforcing the lease.
The professional fees required just to reconstruct Mr. Botha's estate and figure out what the trust actually owned were astronomical. The trust lost massive value in the year after his death, not because the legal structure was flawed, but because the architect left no blueprints for the next generation to follow.
Which is exactly why partnering with a trust consultant like Lumka Sturman is so vital.
Definitely.
You wouldn't build a massive multi-million rand stone castle and just guess if the walls could withstand a siege. You bring in a building inspector to stress test the walls, check the foundations, and look for structural cracks while the weather is still calm.
Because the complexity of the legal codes, the tax implications of Section 7C, and the fragile family dynamics interacting all at once, it is simply too much for any founder to navigate alone.
It really is.
Lumka Sturman's specific mission is to empower South African business owners to build this fortress correctly from day one and to ensure it actually survives the transition when the founder steps away.
Her structured approach is really the antidote to that both the family disaster.
It is.
She starts with a foundation audit to assess your current personal versus business exposure, finding where the risk is leaking in. Then she provides an asset protection blueprint to map out exactly how the assets should flow, setting up the custom trust and company structures tailored to your family's needs.
And what's arguably most valuable for long-term survival is her annual maintenance service.
Tell us about that.
A trust is not a set-and-forget-it document that you shove in a drawer. It is a living entity. She ensures ongoing compliance with SARS, updates beneficiary records, and conducts an annual fortress checkup.
Catching those red flags.
Right, like a snowballing loan account, catching it before it becomes a crisis for your surviving spouse.
The call to action here for you listening is simple and urgent. Don't wait for a crisis to force your hand. The time to prepare the transition is before urgency removes your options.
Partner with an expert who can provide holistic, objective guidance.
Absolutely. You can visit her website directly at www.lumkosterman.com to start stress testing your structure and securing your legacy today.
Ultimately, it requires a shift in perspective. A trust shouldn't just be viewed as a tax vehicle or a cold legal shield against creditors.
What should it be viewed as?
A well-prepared, transparently managed trust is the ultimate gift of preparation. The founder who puts in the work to organize the manual, introduce the advisors, and structure the loan accounts is essentially saying to their family, I cared enough about your future to make the hardest day of your life a little bit easier.
It really is an act of love. You're saving them from the grief-compounded chaos of frozen bank accounts and fractured relationships. But beyond the spreadsheets, the tax laws, and the blueprints, there's a deeply human element to leaving a legacy.
For sure.
A trust deed is incredibly cold. It's just legal jargon, clauses, and stipulations. But you can actually pair it with something called a letter of wishes.
Such a powerful tool.
It's not legally binding, but it is a highly personal document where you get to speak directly to your surviving trustees. It's where you explain your core values, your deepest hopes for your children's futures, and the actual why behind your financial decisions.
It tells the trustees how you would balance those competing family interests if you were still sitting at the table.
Imagine the profound comfort your family would feel hearing your voice, guiding them one last time when you are no longer in the room to break the tie or offer advice.
It makes all the difference.
So as you think about building your asset protection fortress and sealing those watertight doors to keep your family safe, ask yourself, what would your letter say today?